This is the Asia Trade. I'm Avril in Singapore.
And I'm Paul Allen in Sydney. The top stories this hour. Asian stocks set for a cautious open after a flat Wall Street session. Treasuries and the dollar steadying after a sell-off triggered by worries over the surging US debt load. President Trump's signature tax bill heading to the Senate after narrowly passing the House. Some Republicans, though, still pressing for big changes. And the White House escalates its battle with Harvard, banning international students, citing an unsafe campus and alleged links to China. Okay, let's take a look at how we're setting up for the final trading day of the week here in the Asia Pacific. Kind of a mixed picture at the moment. Ahead of the open here in Australia, we've got futures pointing very modestly higher, about 0.25% right now. Nikkei futures traded out of Chicago pretty much flat at the moment. The yen not really moved since the journey it went on yesterday. We're still there at 143.84. It's going to be an important day for Japan. We will be getting CPI data for the month of April a little bit later on. We're expecting to see an easing there to 3.5% from 3.6%. Inflation expectations, though, in Japan remain persistently high. And, Avril, we also have this environment where longer dated bond yields not just climbing in the US, but also Japan as well. We've seen those ultra-long notes, 30, 40-year yields hitting new highs ahead of this CPI data, Avril.
Yeah, Paul, to your point, this week has really been dominated by concerns about fiscal spending, not just from the US, and indeed that's what's been playing out on the longer end of the curve, and a lot of selling there. But we saw in the past session a bit of stability returning, and futures are pointing to a bit more of that as well. In terms of stocks, we saw it pretty flat on Wall Street, wondering how this is going to reflect on the Asia trading session, but keeping an eye as well on those oil prices, because we saw how earlier in the week it was that geopolitical risk, now concerns about US supply, but also potentially the supersized output hike by OPEC+. So a lot to keep a close watch on. But as I say, I think the main focus still about the US and its fiscal spending, fiscal health. Paul.
Yeah, let's talk a little bit more about that with President Trump's signature tax bill now heading to the US Senate. It did get a narrow win in the House. Some Republicans, though, are still pressing for extensive changes, and bond markets, as we just saw, continue to signal unease over the fiscal implications. Senior Congress reporter Jonathan Tamari joins us now from Washington with more. So, Jonathan, this bill now off to the Senate. Could we potentially see some changes being asked for?
Yeah, absolutely. Already today, senators are saying they want to put their own imprint on the bill. They're going to, in their minds, improve the bill, and they hope the House will just accept what they change. I mean, there's a number of different ways that the Senate is looking at this differently. They want to make some of the temporary tax cuts permanent. There are some senators who are wary of some of the Medicaid cuts that are in there. The program for low-income covers health care for low-income individuals. There are some people who want deeper cuts than what's already there. So those are just a few examples. There's some objections to rescinding some of the energy tax credits that had been approved under President Biden. So the Senate is certainly going to change this bill. How drastically, we'll find out in the coming weeks.
Jonathan, we are also seeing that need to get an increase for the debt ceiling, right? I mean, what's at stake here?
Yeah, I mean, this is included in this bill, a $5 trillion debt ceiling increase. And this is a law that needs to be passed in order to allow the U.S. government to pay its existing obligations. And it's never been breached. It's never been violated. There's the assumption that there would be a financial catastrophe if the U.S. defaulted on its debt. Republicans who control Congress are typically very reluctant to approve this kind of bill, and that's why they've buried it within this legislation that includes all their other priorities to try to get their own members of Congress to go along with it. So there's a very high priority on getting this bill done for that reason. If not, they'll have to negotiate with Democrats, and that would be a very difficult negotiation.
Jonathan, when do we expect this to be in front of the president for his signature?
Still tough to say. The Senate is setting a target of passing it through their chamber by July 4th. But if they make some of those changes that we just discussed a couple of moments ago, then that will have to be approved again by the House, and it's unclear whether those changes will be accepted by the House, if that could lead to a new round of negotiations. So we're looking at, early July at the earliest, and possibly much later into the summer, depending on how the House reacts to any changes that the Senate makes.
All right, Bloomberg Congress reporter Jonathan Tamari there. Let's get a little bit more on this with Garfield Reynolds, who leads our Markets Live Asia coverage. Garfield, Jonathan there telling us about how a number of lawmakers on both sides of the House not happy with this bill. Certainly the bond market's not happy with this bill. And we've seen before how, as President Trump called it, a yippie bond market dictated a change on trade policy. Could it happen again with this?
Well, you could certainly get a severe bond market reaction to the optics of this bill, to the idea that the US is going to go on boosting its deficit. The balance of what the House came up with maybe leans a little bit less into deficit increase than had at first seemed to be the case. But you've also got the difficulty that President Trump is very much against big cuts to Medicaid, even though that's seen by the conservative side of the Republican Party as being something that needs to happen. So that's a confrontation that's coming. The difficulty as far as resolving the bond market yips, as it were, is that President Trump can't just sort of snap his fingers and suspend things for 90 days and say we're going to negotiate it, because this is very much about what Congress decides. He obviously can have a large influence on what the Republican Party members decide, but ultimately it's up to them. So that could make the remedies difficult. One thing that has been lurking in the back of some of the action recently is chatter that at some stage the Trump administration could revive this plan to shift the regulations on how many treasuries banks are allowed to hold. And if they did that, that would free up demand, and that could bring yields back down, at least in the short term. So that would be a short-term fix that could take some of the heat out of the market. But in general, I think we're going to go on having these concerns about bonds, and that's going to keep yields more elevated than they otherwise would be, even if there might be other factors that could bring them down at some stage.
What is this all going to mean for stocks then, Garth?
Well, you can see how nervous stocks have been the last couple of days. And even when bonds sort of came back, yields came back down a bit yesterday. Equities still struggled to make a lot of headway. They're facing this fear that yields will remain at these sort of levels or higher, and that's a problem when it comes to valuations for equities. Part of what goes into a lot of investors' ways of looking at whether it is worth buying equities is, what is the fixed income guarantee that you can get? If you can earn 5% a year on 30-year yields, then it's a higher bar for equities as far as where they're going to go for them to be worth the risk of investing in them. The other thing I think that's still lurking in the background for stocks, helping to make them nervous, is what will the impact of the tariffs that are in place be? Will that end up bringing earnings down by the sort of amount that is expected? And then for equities look for the tax cuts in the big bill to come through as a way to revive economic growth and therefore make those earnings make sense. The double-edged sword there is, if the bill drives yields higher, then that undercuts that potential boom. So all of that adds up to a nervous stocks market.
Garth, great stuff. Thank you so much. Garfield Reynolds, who leads our Markets Live Asia coverage. Now, the other big story we've been tracking today, the Trump administration is blocking Harvard University from enrolling international students, escalating its fight with the elite U.S. college. The ruling will compound Harvard's financial pressures after the White House cut billions of dollars in funding and future grants. For more, we go across to Bloomberg's John Harney in Washington. So, John, I imagine this would be a major blow to not just the university, but foreign students as well. Talk to us about the significance of all this.
Well, it certainly escalates this campaign against Harvard and also other institutions in America that are perceived, rightly or wrongly, as liberal. Harvard enrolls some 6,800 foreign students at present. That's about 27% of the student body. And that's not just, and they don't just pay tuition. They also spend money on rent, on clothes, on food. And this will have, if they all have to leave Harvard, that could have quite an impact on the economy of Massachusetts, where, of course, Harvard is located. It is, but it's all, the students have been told that the students who are enrolled now have to transfer or lose their legal status in this country, and that no new students can be enrolled.
John, is this even legal? Are we setting up for a court battle here?
Well, here we go with yet another more litigation that the Trump administration has initiated or has brought about. Yes, Harvard says this is indeed illegal. It amounts to an assault on academic freedom as well as free speech. And this is one of many fronts, if you will, that the administration has opened in its clash with Harvard. It has Donald Trump himself has called for the university to lose its tax-exempt status. Some $2.6 billion in funding has been held up, and Congress, in the bill that was passed early Thursday morning here, has raised, their bill calls for raising taxes on institutions like Harvard.
All right, Bloomberg editor John Harney there. Still to come on the Asia trade, we'll discuss the fiscal outlook for the US with new Century Advisors. FuturePlay joins us to talk in tech investment strategy. That's live from the Beyond Expo in Macau. Plus, we will speak with Lenovo's CFO after quarterly profit fell far short of market expectations. Much more ahead. This is Bloomberg.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very US exceptionalist, US, and we have seen some shift from US to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
Some of our guests at the Qatar Economic Forum in Doha with their views on President Trump's trade war. But more now on the bond market's unease over the president's tax bill, which is on its way to the Senate after narrowly passing the House. 30-year Treasury yields remain above 5%, I should say, as the nation's creditors deliver the president a dose of reality over his fiscal plans. And joining us now is Claudia Sahm, chief economist at New Century Advisors. She's a former section chief at the Federal Reserve and is also the creator of the recession indicator known as the Sahm rule. So, Claudia, really good to have you with us. First off, I have to ask you, as an economist, are you looking at the way in which investors are looking at the US twin deficits and saying, no, we're not going to fund that anymore, and saying, yeah, that kind of makes sense? Is that your assessment at the moment?
So I think this is a moment of a massive amount of uncertainty. The policy making in the United States has really, is very unsettled. We've seen a lot of executive actions coming from the president, from tariffs to downsizing the federal government, and now we have the one big beautiful bill working its way through Congress that is historic in its size and scope, and it has, I think right now there's a moment of market investors maybe being unsettled by the fact that it really does not appear to be making good on the idea of fiscal discipline or trying to rein in the deficit spending. I mean, this, the legislation as it is right now, and it's going to go through more iterations in the coming, weeks and months, it would substantially increase the federal debt over the next 10 years and probably even more than what the legislation is written for. A lot of these temporary tax cuts sunset, and in all likelihood they probably would be extended going forward. So I think there's good reason for the markets to be really concerned about the sustainability.
So we could see higher yields yet potentially, and maybe the costs for money for households, for businesses, climbing even higher. Do you see this as making it even more difficult to rein in the deficit then, self-reinforcing? And what is that going to mean ultimately?
Right, and I think that's where the higher interest rates, as you said, can be self-reinforcing, because then that means that the government's spending more and more money just financing the debt that they already have on the books. And in addition to that, we have other policies like the tariffs that are putting a potentially inflationary impulse into the economy and also pushing up interest rates. So unfortunately, we're in a period where there is some lift to interest rates. Now, I don't think we're in a moment where it's a crisis of confidence and the U.S. is losing its safe haven status, but it's really risky when we're in a moment where that's even in conversation. And so I think the one thing that I do foresee for the coming months is that we're going to have a lot of volatility in these rates. And so trending higher, but I think what may be more painful are the days where we have some sharp moves as we learn something unexpected about the policy outlook, or as we start to see the policies filter through into the data in unexpected ways.
Claudia, it's interesting that you mentioned tariffs there, because we saw the bond market flex its muscles not that long ago and force effectively a 90-day reprieve on trade policy from the Trump administration. Could we see the bond market effectively forcing an austerity program down the track in the US?
It certainly is possible. The processes are very different. The tariffs are being run entirely through the White House at this point, whereas Congress is different in its decision making. Although I will say it is clear, particularly as the budget reconciliation worked its way through the House, that President Trump is exerting a lot of pressure on lawmakers to move this bill through. So it's possible we could see that pivot. But I think over many years, we've seen Congress, Republicans very committed to having, continuing to do tax cuts. It is notable there are some big spending cuts that are coming in some of our safety net programs, Medicaid and food stamps. But, we just haven't, on either side, we have not seen a commitment to fiscal discipline. And that's just not happening right now either, even when we have Republicans, House, Senate, and the White House. That's not the direction this is going. So it'll have to be a very loud signal from the bond market, and frankly, one that I hope we do not have to hear. I mean, because that would be very disruptive. So I wouldn't hold your breath for this getting a much more reining in the deficit policy. I don't think that's where this is headed.
To your point, debt, deficit, the extraordinary amount of interest that the US pays on its debts, none of these problems are new. They've been around for a very, very long time. What, in your view, is needed in terms of reform to address this? And what's going to happen first, reform or a reckoning?
Unfortunately, it will probably be the reckoning first, because the reform is painful. So the piece of the U.S. federal deficit that's really large and growing are some of our most key kind of entitlement programs. So whether it's Social Security, Medicare, these are programs that, millions of Americans rely on. These are really bedrock programs, and to go in and make cuts in terms of either, people have to pay more in terms of their benefits or their benefits aren't as generous. I mean, these are ones that are just going to be very politically painful for any politician to vote for. And until we talk about those large entitlement programs, the issues with the deficit being high, the federal debt being on an unsustainable path, we're just not going to make a lot of headway. And again, those are going to be really difficult politically to do, and that's where there will have to, in all likelihood, there'll be some kind of a reckoning that gets politicians to that point.
Claudia, one last question for you. What do you think is the Fed's best course of action amid all this for the rest of the year as they weigh out Trump's policies? How should they approach all this?
Right, so with the high degree of uncertainty on the policies, and again, I can't underscore how different this is. We have all kinds of policies already in place that are being contested by courts, going before the Supreme Court. We don't know, are the tariffs going to stick at the lower, they go higher, right? There are so many just on the basic, what are the policies going forward, let alone what are the effects of the policies. And unfortunately, the administration is pursuing policies that have a stagflationary impulse of higher inflation and potentially higher unemployment. The Fed, what they're doing right now, staying on the sidelines, watching very carefully, that is the right approach for them. Unfortunately, that could come at some cost, right? Because a delay in terms of adjusting policy, means that, the interest rates don't work through the economy, don't have the same effect. And yet right now, with the uncertainty as high as it is, it's really hard to say what's the right move for the Fed. So they're right to be on the sidelines, but it's a very unfortunate situation that we're in.
All right, Claudia Sahm, we'll have to leave it there. Thank you so much for joining us with your insights. Claudia is Chief Economist at Century Advisors. We have more ahead on the Asia trade. This is Bloomberg. You might have noticed this week the backdrop here behind us in Sydney has not looked its usual beautiful self. There's a reason for that. The weather has been absolutely wretched, fatally so. 4 people have now lost their lives in flooding in New South Wales. The area north of Sydney has copped rainfall that we haven't seen since the 1920s. More than 500 people have been rescued in various flood emergencies around the region. Still some people missing as well in these floodwaters. There's more to come also. The Prime Minister, Anthony Albanese, is going to be visiting the mid-north coast of New South Wales later on today. He's announced that there is going to be disaster allowance available from Monday next week. That funding will provide 13 weeks of fortnightly payments to people who can't work or are going to lose income in the wake of this disaster. And it's not over yet. More rain forecast for the very soaked areas of New South Wales. So we have more ahead on the Asia trade. Stay with us. This is Bloomberg.
You're watching the Asia trade, and we have those numbers on the Japanese CPI coming out for you. Of course, hotly anticipated, and on the headline print, slightly higher than expected. 3.6% is where we're seeing it for the month of April. Excluding fresh food, that number comes in at 3.5%, also slightly hotter than expected. If you're looking at exclusion from fresh food and energy prices, that is bang on the dot, in line with expectations. And for more on all this, as well as Japan's economic outlook, let's bring in our economy and government reporter, Erika Yokoyama in Tokyo. So, Erika, we're seeing, when it's the headline print, a bit hotter than expected, but maybe a bit of relief when it comes to the core print, not bucking expectations, so to speak. What do you make of all this data?
Yeah, it's another escalation, and there is no sign of it cooling off anytime soon. So I think it will add the pressures on policymakers, especially Prime Minister Ishiba, with the key election coming up in 2 months' time. And like the biggest driver behind these kind of like the inflation is actually the cost of food. In particular, people are now really unhappy and sensitive about the price of rice, the nation's staple food, and actually the public dissatisfaction, frustration over the rice price actually partly led to the recent resignation of the agriculture minister after he's making some controversial remarks as well. To ease the public frustration about the persistent inflation, Ishiba said he's considering an economic package and possibly present the framework ahead of the election. Actually, he already rejected an idea of implementing consumption tax cut, which was the idea mostly presented by an opposition party. So now he needs to come up with something better idea and more convincing idea for voters. But I think that's pretty much complicated for him.
So, Erica, inflation running hotter than expected. Does this demand a more robust policy response from the Bank of Japan?
That's right. Yeah, the prices are still running hot. I think actually it gives the BOJ reason to consider another rate hike sooner than later. And actually, BOJ officials have been repeatedly said that the bank will consider another rate hike, keep raising interest rate if their price outlook is materialized. However, they are also increasingly voicing concerns about the uncertainty stemming from the U.S. policies. Like the BOJ officials will be meeting soon again in mid-June, and most of the economists are actually not expecting any moves at that meeting. However, by then, I'm pretty sure the BOJ will be closely looking into any data beyond price as well, especially like business sentiment and like household attitudes, as well as the trade data, and to see like how they are reacting to the current uncertainty.
Erica, you alluded to some of this food prices, right, and how that's politically an issue or turning out to be one. How do you see this all playing out potentially into upper house elections? I mean, what are you seeing in the economy and what we should be watching out for?
Sure, yeah, definitely the food price is one of the things that the Prime Minister Ishiba needs to take care. And, like his support rate is falling to the lowest since he took office in October recently. So he definitely needs to come up with the idea to shore up his support before the elections. Then economic package under the discussion could be one of them. Then the other thing is also, what matters for the election is the ongoing trade negotiation with the U.S. actually. And, like Japan's lead negotiator Akazawa is heading to Washington today, but, like there seems to be only a little progress this time, as reportedly he's also going back to Washington again later this month. And it seems to be, the negotiation so far seems to be really tricky, because like Japan has been asking for full removal of the tariffs compared to the other nations. Like UK already reached the deal with the US by lowering tariff instead of like full removal. And there seems to be some reports going on about possible leverage that Japan can offer, including like boosting agriculture products from the US or easing regulations about auto imports from US, or even like collaboration in the shipbuilding sector. But there seems to be no progress on that. So Ishiba basically needs to take care of the domestic economy, especially like weak consumption, high prices, as well as the diplomacy, including the the trade negotiation.
Erica, fantastic. Thanks so much for breaking all that down for us. Bloomberg economy and government reporter Erica Yokoyama. Now, Bloomberg has learned that OPEC Plus members are discussing a third consecutive increase in oil production in July. A final decision is due to be taken at a gathering on June 1st. Let's bring in Steven Stepczynski, who leads Bloomberg's Asia energy coverage. So, Steve, what do we know about whether we're going to see a third straight output hike? And, this time it could be a supersized one.
Right. What my colleagues reported out yesterday is that they could add add 411,000 barrels a day to the market in their next hike decision from July when they meet June 1st. Now, of course, that would be the third consecutive month of increases, and it would be the third supercharged increase. These increases have been larger than their initial plan, so it has added this bearish element to the oil market, and prices have fallen quite a bit because of that. Now, of course, you have to take a step back and see what they're actually going to do. Now, according to the report, they're going to look at different scenarios, and the most extreme would be that supersized one, which would be a 411,000 barrels a day increase for the OPEC Plus members. Now, there are a few reasons why they would do this. One, they actually see the demand in the market, or two, they're punishing OPEC members who aren't complying with the with where they're supposed to produce, the numbers that they're given. That's primarily countries like Kazakhstan, for example, has been overproducing. And so this is one way to punish them. And then lastly, it's also potentially a way to get market share away from U.S. shale producers. With oil falling, shale producers are going to have to pull back rigs. It doesn't make economic sense for them to be producing at this oil level. It's uneconomical. So that also gets some market share, and actually, interestingly enough, also wins maybe some brownie points with Trump, because Trump, while he is supporting the oil industry, he does want lower oil prices and a lower price at the pump.
Stephen, regardless of OPEC Plus's motivations for these decisions, how far are they likely to push this? Where's the floor for the oil price?
Well, prices do just keep falling. It really depends on what happens, not just with OPEC Plus, but also geopolitically, right? So we're around $64, a bit below $64 for Brent. There is a view that if OPEC Plus keeps doing this, it could add some downward pressure. But you also have to take a look at Iran. Bloomberg Intelligence had a report that if the Trump administration were able to have some sort of agreement with Iran to remove the sanctions against their oil exports, then you could see oil prices fall to about $40. And then if you add on top of that the bearish outlook for the economy, the IEA expects that oil demand is going to lag for the rest of the year. If the trade war flares up again, that risks demand in China, the world's biggest buyer. All of these things together you have to keep in mind. So I wouldn't so much say where is the floor, so much as where are the pain points that are going to come through in the market, and how low could it go? And BI says it could go into the $40 level.
Steve, thanks so much for coming in and bringing us these nuances. We're also seeing this sort of historic break of OPEC Plus after years of defending the market. Great to get your analysis. Steven Stupczynski, who leads Bloomberg's Asia energy coverage. Now up next, OpenAI is considering locations in the Asia Pacific for future data center sites. More details coming up. This is Bloomberg.
OpenAI is considering locations in the Asia-Pacific for future data centers, joining an already heated race to build out AI infrastructure in the region. Mandeep Singh heads global technology research at Bloomberg Intelligence, joins us now from New York. So Mandeep, why is OpenAI considering a data center expansion in Asia now?
Well, when you look at, how these frontier model companies are expanding, they're talking about really expanding their footprint, both in terms of, the data requirements that they have by region, as well as, the reach they have in terms of the user base. So for a company like OpenAI, they have about 600 million plus weekly active users. I would say more than 50% are outside the US. And at this point, if you're not serving that traffic with the data center that's in that region, then really you may run into problems down the line, because these companies are training their models constantly. So it doesn't surprise me that they want to be in the race along with the hyperscalers like Microsoft, Google, and I think that's what they are positioning for. I mean, so far they were reliant on Microsoft, and now they want to build their own infrastructure.
Yeah, you mentioned Google there and how it's among, I think, the big tech firms. They're doing all they can to jostle in this very competitive AI space. We're hearing about a DOJ's investigation of Google Character AI. What can you tell us about this?
Well, so this was an acqui-hire they made back in 2024. And remember, during President Biden's term, the big tech companies weren't making a lot of acquisitions. So Google invested about $2.5 billion in this company, Character AI. They licensed their content, and they actually hired one of their co-founders. And if you look at what Microsoft and Amazon, they also had similar sort of investments where they didn't really make an outright acquisition, but they ended up making these big around $1 billion type of investments. And now the DOJ is really looking into that arrangement because it wasn't an acquisition. At the same time, $2.5 billion for licensing their content seemed to be high. So it's really an investigation into why Google invested like that as opposed to making an acquisition.
If we take a step back for a minute, how would you overall characterize demand for AI infrastructure at the moment?
I mean, look, this is the big investment that's going on, and it's a multi-year trend. We saw that in the Middle East, when President Trump was there. He signed a few deals in Saudi Arabia and Qatar and UAE, and a lot of them were around AI infrastructure. And globally, I feel right now, every country is looking to build their AI infrastructure. That's why the sovereign AI investments could become a pretty big category in terms of driving this AI demand, similar to what we have seen with the hyperscalers, who will be spending almost $320 billion in capex this year. So we're talking some pretty big numbers in terms of investments in AI infrastructure, and it's led by a lot of the countries that are involved. So it's not surprising that everyone is trying to go at the same time. Is there a risk that we may have some overcapacity down the line? Probably, but right now no one is thinking about that. Right now it's an undersupplied market, and everyone wants to make sure they have their own infrastructure.
All right, Bloomberg Intelligence's Mandeep Singh there. China has asked the Netherlands to relax export restrictions related to semiconductors. And that's according to Dutch Foreign Affairs Minister Casper Veldkamp, who met with his counterpart in Beijing. Bloomberg tech reporter Annabelle Drewlers joins us now from Macau with more. Belle, is this really a decision for the Dutch to make? One imagines that the US might have a position on this conversation.
Yeah, that's right. I mean, the US has really been pushing the Netherlands to follow along or keep in lockstep with its export restrictions. But just to take it back a step and think about what the Netherlands has, which is, of course, it's the home of ASML. It's the only company in the world that can produce high-end lithography machines. Now, these are essential for making the most advanced semiconductors in the world. So China obviously wants access to these. But as you said, we had the meeting between the Dutch Foreign Minister, Casper Veldkamp, and his Chinese counterpart, Wang Yi. This is the first trip we've actually seen by a Dutch cabinet minister since the new administration came into power last July. But at the same time, Casper Veldkamp really downplayed any irregularities. Of course, if you're China and you're restricted from accessing these machines, it's natural and normal that you're going to be asking for them to be sent at really any availability. So he said that that was in China's interest, but he also said what was the Netherlands' interest, which is maintaining national security and also keeping autonomy or decision-making capabilities around autonomous licensing. So that was his view. But still, I mean, China, yes, it doesn't really have any sort of way to replace this technology or to substitute it. It would like the rules to be changed. The Netherlands, as you said, has been keeping along with the US moves. There was common ground that was found, though, because both sides, the Netherlands and China, did agree to keep the communication ongoing around semiconductor technology, deepen areas of cooperation in technology areas where it can, and also as well deepen the ties around trade.
Belle, I think this also speaks to that theme of self-sufficiency for the Chinese when it comes to chips. We're also watching from the likes of Xiaomi. They have some pretty ambitious plans, including for mobile chips from their tech showcase recently. They're touting their SUVs as well. What are the plans in the next couple of years for Xiaomi?
Yeah, Xiaomi, a company in its 15-year history, has really gone from being known for producer cheap smartphones, consumer appliances, to having very, very bold ambitions, and is really executing on those as well. So yes, as you said, overnight we had the founder, Yichun, holding a live stream event in Beijing where he talked through the latest company announcements. Front and center was the EV push, and this is notable as well because there was an incident back in March that involved a Xiaomi sedan, and it did result actually in fatalities as well. So that certainly did dent the appeal of Xiaomi's EVs, and we actually saw orders as well dipping in April. But Yichun, he took to this live stream very much focused on restoring the brand appeal and also announcing new cars to come. So they're going to be unveiling their first ever SUV that's going to be known as the SU7 later this year, or YU7 later this year rather. He's saying it can go 760 kilometers on a single charge. It can also reach 100 kilometers within 3.23 seconds, which he says is comparable to what you can get from a Porsche. It's better than what Tesla's Model Y can do as well. So that was the EV focus. But yes, semiconductors and processors for smartphones in particular, the big focus of the company as well. We got that announcement around the Shring 01. That's their new semiconductor essentially, but they're going to be using that into their devices and really going head to head with the offerings from Qualcomm and Apple as well. So that was the semiconductor side, and then as well big plans ahead because the company's been unveiling, or they did unveil, nearly $30 billion of planned R&D that's going to be put into practice over the next 5 years. So yes, an evolution of the company of sorts, and Xiaomi, as we said, very, very focused on that strategy of home, car, and also device, and that ecosystem, bringing everyone into the Xiaomi realm.
It's quite a mix. Belle, thank you so much. Annabelle Drawlers, our Bloomberg tech reporter. Now, speaking of, when we're looking at tech stocks in Asia, we've seen investors in the region kind of turning back to them and dialing back on defensive shares as easing trade tensions reduce concerns over the global growth outlook. Our Asia equities reporter, Winnie Su, joins us for more. So, Winnie, it's quite a turnaround we've been seeing for Asia tech stocks. What are the key drivers of this rotation?
Yeah, morning, Avril. So this is a very interesting trend that we're seeing right now. Earlier in April, we saw that people were piling into defensive stocks, especially those consumer staples, citing the heightening geopolitical risk. And just in 1 month, we saw that trend reversing. And right now, actually, the Asia info tech sector is the top performing sector in the past month. And the consumer staples are actually one of the worst performing sectors. So that shift really is rapid, and it's showing that investors are becoming more tactical when it comes to positioning within these different sectors amid this whole geopolitical tension. But the trigger really here is that U.S.-China trade truce that we saw earlier a few couple weeks ago, and that is helping with the sentiment, risk on sentiment coming back a little bit, and supporting the outlook of global growth, and also reducing the risk of the U.S. recession. So while those are kind of the key drivers for supporting the growth stocks and tech stocks here, we're also seeing that, with the risk of the deterioration of China-related supply chains also coming down, people are turning more positive on the regional tech supply chains. So we're seeing the names, the top performers really in tech stocks, the ones that have a lot of U.S. revenue exposures. So those have been really picking up strength.
Winnie, we are, of course, seeing Treasury yields rising, particularly on the longer end of the curve. Is this posing any risks to the Asian tech rally?
Yeah, so when you look at growth stocks, usually it goes, whenever we have higher yields, that's adding more pressure to these names. However, recently when we're seeing the higher yields, it actually has a decoupling trend with the strength of U.S. dollar. So with the weakening of the U.S. dollar and also we're seeing that the Fed potentially might come into cut rates if we're seeing the economic outlook for the U.S. to worsen. That's actually good news for the Asian currencies, and it provides Asian central banks more room to cut. So at this moment, it's not necessarily negative news for Asian tech stocks anymore. So it really depends on how far we can see the Asian banks to continue to cut rates. So if we expect the dollar to continue its weakening trend, which is what strategists have been expecting so far as we've been talking to them, that is still supportive for growth stocks in general.
All right, Asia Equities reporter Winnie Su there. We have more ahead on the Asia trade. This is Bloomberg. Let's get the latest from the corporate front. BYD has sold more EVs in Europe than Tesla for the first time, overtaking the American brand that long held the lead in that market. Market researcher Jato Dynamics says BYD's new EV registrations in April jumped 169% from a year earlier. Tesla placed one spot back as its registrations fell 49%, even as EV sales in Europe rose overall. Bloomberg has learned Apple is looking to release smart glasses at the end of next year in a challenge to rival Meta's Ray-Bans. Sources say the glasses would have cameras, microphones and speakers and handle tasks such as phone calls, music playback and live translations. Meanwhile, Apple has shut down work on a camera-equipped Apple Watch, but is still looking at AirPods with cameras. All right, let's take a look at how futures are poised as we count down to the open at the top of the hour, all in modestly positive territory. Of course, Japanese stocks and bonds will have a chance to react to that slightly hotter than expected inflation print we had a short time ago. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens. And of course, Paul, we got data out of Japan, fastest pace of inflation rises in 2 years. Certainly something that could pose a bit of a political risk for the Ishiba administration.
Yeah, definitely some concerns there, and perhaps a call to action for the Bank of Japan as well. And we have seen longer dated yields in Japan rising, but to be fair, they've been rising pretty much everywhere, Avril.
Certainly, and we're keeping a close watch on the yields in Japan, not just on the long end, but if you're looking at the yield on the 10-year, note that it's actually not far from the highest since 2008. The level to watch is 1.59, and certainly to your point about how this maybe complicates things or maybe feeds into the case for the Bank of Japan in terms of future rate hikes, that is playing out, I think, on the Japanese yen, where we seeing a bit of that firmness. But of course, we are seeing that expectation, maybe not just yet playing out on Japanese bonds, although we saw a bit of that reaction when it came to Japanese bond futures. I think the undercurrent for today is mostly how the dollar treasuries overnight sort of rebounded. So looking at Japanese equities, shaping up to be quite a good day, 0.5% thereabouts on the gauges. Flip the board and take a look as well at the South Korean markets. We're still holding at 1380 when it comes to the Korean won. Also seeing a bit of firmness when it comes to stocks in the country. Paul.
Yeah, well, just open for trade here in Australia as well. Of course, hard to get a read on things with the staggered opens. So we're kind of flat at the moment. But let's take a look at what's been happening in the bond space as well. You can see the 30-year yield now backing off a little bit. We did hit 5.15% in the US session, so a little bit of easing there for the long end of the curve because, of course, as we heard, President Trump's great big beautiful tax bill did clear the House very narrowly, on its way to the Senate now. Certainly big, but the bond market's not been shy about sharing its thoughts on its beauty. This does extend tax cuts, but also deficits. The debt ceiling's been raised another $4 trillion, so definitely some concerns there over the sustainability of this path. Let's take a look at the oil price as well. That's moving lower. We understand that OPEC Plus is considering another output increase in July. This is according to delegates who declined to be named, but if it happens, that would be the third consecutive production increase. A number of potential motivations here. OPEC Plus officially says this is to satisfy demand. Unofficially, it does seem about punishing production cheats as well. Let's get to our next guest, who says the Fed's probably going to keep rates higher for longer. He also sees more volatility in long-duration fixed income. Let's bring in Thomas Tornau, head of APAC investment strategy at BlackRock. Thomas, a little bit of reprieve for the long end of the curve today, but when you're looking at some of these longer-dated notes, at what point do yields become attractive enough to make you want to step in?
Well, certainly not yet. We're still underweight duration as it stands in the U.S. and looking more towards the short duration part of the curve. I think all eyes are going to be on the U.S. 10-year, whether that can breach 5%. Most of the volatility has been in the 30 years at the moment, but certainly it seems to me like the bond market is speaking. Equity markets aren't really listening at this point. All these measures that are coming through, whether it's tax bill, tariffs, et cetera, these are all inflationary type of measures. And so I think any way you cut it, no matter what the end numbers are for tariffs, this is an inflationary type of environment, and that's going to impact what the Fed does in terms of future meetings. So that's why we keep saying higher for longer, stick to short duration in fixed income for now, at least in the U.S.
Well, in this environment, let's talk about where you see opportunities. I know that you see a chance to be selective in the credit space. Can you tell us a little bit more about that?
Yeah, I mean, we've seen a lot of clients looking at investment grade type of strategies, but mostly, we're looking at the credit space. We're looking at Asia. So, there's a lot to like in Asia in terms of the inflation growth mix. And also the ammunition that central banks here in APAC have in terms of being able to cut interest rates because of that inflation and growth situation. So we're taking a lot more of an active approach at the moment, moving a little bit away from Asia high yield and more into Asia credit. So I think it's really about trying to find where the right duration yield mix is, and we certainly are seeing that in Asia credit at the moment. So I think there's a lot to like there, not just in credit, but also in Asian equities.
Thomas, when it comes to Asia stocks, we were just talking with our reporter, Winnie Su, earlier, and how that rotation back into tech is underway. But it's also seen as one of, obviously, the ones most prone to geopolitical risk, potentially. What do you see as the drivers in the near term?
Yeah, I mean, this is, if you look across the major tech markets here, right, so South Korea, Taiwan, and China offshore, I think they're moving in slightly different lockstep, because if you look at Taiwan, South Korea, these are more like high beta type of exposures, tariff pressures coming off. Investors move back in. There is a big valuation differential between South Korea and Taiwan, and so generally we're looking more at South Korea than Taiwan at the moment. And then you have China offshore tech. And I think it's interesting because foreign investors have been looking at Taiwan and South Korea, but certainly not, at least U.S. investors have not been buying China tech at all. So the majority, if not all of the inflows into some of these China tech names is being driven by onshore money, whether that's through ETFs or southbound stock connect. So I think there still is a lot to like in China. You have offshore and onshore. Obviously, clients are either moving into one or the other or using an MSCI China type of approach because it encompasses everything. But I did say at the beginning of the year, I think China can outperform U.S. this year, and I think that is still the case. I think the question now is whether you rotate from China tech into China onshore because of the pickup in consumption from retail investors there. I think that's kind of the big question at the moment.
So what is your inclination on that?
I think at the moment it still looks like China tech is the trade. And the reason for that is because it's a little bit counterintuitive, but the ratcheting down of the tariff situation between U.S. and China, even though it is still a 90-day hiatus and we don't know what the end numbers are going to be. But generally, when those tariff numbers come down, it implicates that the People's Bank of China is actually going to be less aggressive when it comes to cutting rates, putting in stimulus into the market, and those type of policies are actually better for the domestic market and not as much for the offshore names, which are more of the exporters. So I think it's still offshore China tech, but certainly I can see a case given the valuation differential where investors will move into the domestic type of space. But that is going to be very much driven by whether we actually see consumption come back from China onshore, which is something we haven't really seen since COVID. I think we're starting to see little green shoots of it, but that data is lagging. And so I think probably another 3 months before we start to see that rotation.
Thomas, we're having emerging market stock trading at their highest since October. Is this an area that you're looking at, considering a lot of forecasting around the US dollar continues to be weaker for longer?
Yes, certainly. And we see that in the flows as well, not just in equities, but also in emerging market debt, more in local currency, not so much in US dollar, which makes a lot of sense. I mean, this is a rotation trade we're seeing not just in emerging markets, but also in Europe. So it's kind of like, where do I go outside of the U.S.? You can go into Europe, you can go into emerging markets. And in emerging markets, clearly there's a large weighting towards China, and China has been performing very well. And then, as you said, the U.S. dollar depreciation tends to be quite good for emerging markets. Then on top of that, you add in the inflation growth dynamic looks quite good in Asia. Asia is about 3/4 of the EM index. So I think there is still quite a lot to like there. And you can kind of see this in terms of the flows, but also the hedging mechanisms that are going on with U.S. dollar. So you see U.S. dollar depreciating, yields going up. All these kind of things are quite good for this rotation trade into emerging markets. But again, I think this is more of a tactical trade at the moment.
Potentially supportive of Asia stocks nonetheless. Thomas, thanks so much for your analysis. Thomas Tor of BlackRock. More ahead on the Asia trade. This is Bloomberg.
President Trump's signature tax bill is heading to the US Senate after a narrow win in the House. Some Republicans, though, are still pressing for extensive changes, and bond markets continue to signal unease over the fiscal implications. Let's bring in Bloomberg editor now, Jill Desis. So, Jill, tax cuts extended, the debt ceiling raised again, deficits forever. The bond market's obviously got a problem with a lot of this. Does anybody on Capitol Hill have a problem with it?
Yeah, well, Paul, I think that at this point now what we have to see is how much of an implication some of those concerns about that ballooning debt really have in the U.S. Senate. That's where this bill then heads to. So, again, as a reminder, it includes a $4 trillion increase in the U.S. debt ceiling while it extends the tax relief from the tax cuts from Trump's first term. It also adds hundreds of billions of dollars a year to the deficit. What Trump was able to do was overcome a lot of that Republican infighting in the House, get things like some of what the more Republicans from higher tax states like New Jersey, New York, California, they wanted an increase to state and local tax deductions, that cap limit. They got that increase, some other cuts to Medicaid there. But ultimately, now they're going to have to figure out how to sort of reconcile all of that in the Senate. They're trying to get this through a procedure that would allow them to get just a simple majority of votes. But ultimately, it still may be a couple of months before we actually see something, pulled together here that can placate those Republicans in the Senate. Again, just a lot of concerns about, this ballooning amount of debt. We'll see how much that continues to be a factor in the conversation. Obviously, the bond market wants it to be.
Jill, the other story that you've been tracking for us is what's come out of the G7. We've gotten this communique, and they are pledging more or less to address excessive imbalances. Seems like a veiled reference to China. What is the outcome of all this?
Yeah, Avril, it's an interesting, G7 finance ministers meeting here. I mean, obviously going into this meeting, one of the big overhangs here, kind of an albatross, is just what's happening with the U.S. and tariffs and trade. And it does seem at least like U.S. Treasury Secretary Scott Bessent was able to placate some of those finance leaders a little bit while they were in Canada this week. Obviously, still a lot of those issues involving working out tariff negotiations, trade negotiations with the U.S. remain. But it does seem like, all of these finance ministers went into this meeting saying, the big focus here is how can we unite, against, in particular, China. Again, you talk about those veiled references in that communique. It does seem to be that that's the implication here, is that they're talking about more of their commonalities than differences. Obviously, I think we'll have to see how this carries over into the G7 Leaders Summit next month. The White House did say that Trump is going to that one. So we'll see, how exactly all of this continues to unfold when those leaders meet back in Canada in June. But yeah, at least for now, it does seem like, those G7 partners all, are kind of uniting on that common outlook of, what can we do to sort of constrain China.
Yeah, the other big leader meeting on the calendar to watch out for. Jill Deesis, our Bloomberg editor, thanks so much. And some other stories that we're following. The Australian state of New South Wales is bracing for more heavy rain into the weekend after floods killed at least 4 and left thousands without power. Some areas have recorded 600 millimeters of rainfall over the last 4 days. That's about 24 inches. Road access has been cut for around 50,000 people, and emergency services have rescued more than 600 people. Iran says it'll retaliate and hold the U.S. legally responsible if Israel acts on reported plans to attack the Islamic Republic's nuclear facilities. The warning was issued in a letter addressed to the Secretary General of the UN and the UN's nuclear watchdog. Iranian Foreign Minister Abbas Araghchi urged them to take effective measures against Israeli threats. A man charged with the murders of 2 Israeli embassy staff in Washington has appeared in federal court. 31-year-old Elias Rodriguez wasn't required to enter a plea and will face court again in June. Officials have called the shooting outside the Capitol Jewish Museum on Wednesday an anti-Semitic hate crime. It's been condemned by the Israeli government, President Trump, and U.S. lawmakers from both major parties. And the U.S. Supreme Court has shielded the Fed from President Trump's push to oust top officials at independent agencies. The court ruled the Fed is a uniquely structured quasi-private entity. The decision is likely to quell concerns for now that the president might move to fire Jerome Powell. But the top court upheld Trump's powers to fire leaders from other U.S. agencies. Paul.
Well, the Trump administration is blocking Harvard University from enrolling international students, escalating its fight with the elite college. The ruling will compound Harvard's financial pressures after the White House cut billions of dollars in funding and future grants. For more on this, we go to Bloomberg's John Harney in Washington. John, the first reaction to this is, is it even legal? This looks like it's got a court battle written all over it.
Of course it does, but this development, this announcement, came as a bit of a shock even after these other moves against Harvard, as you point out, the $2.6 billion in funding that's been cut, that's been frozen, along with President Trump's own demand that the university lose its tax-exempt status. And even in the House bill that was passed early this morning, that calls for dramatically higher taxes on the endowment of organizations like Harvard. Now, the pretext for this, or the reasoning, is that Harvard has fostered anti-Semitism on campus, and as the Department of Homeland Security said, tolerated anti-American pro-terrorist activity. Harvard and Harvard's President Alan Garber and other university leaders around the country do admit that anti-Semitism has been a problem on campuses, particularly after the October 7th attack by Hamas on Israel and the war in Gaza that began shortly after that. But they say that this amounts to an attack on not only on academic freedom, but on freedom of speech itself.
John, what is your sense of whether this action by the Trump administration could at some point extend to other colleges beyond Harvard?
Kristi Noem, the Homeland Security Secretary, went on Fox this afternoon and made that quite clear. She said that other universities, that this amounted to a warning to other universities unless they, as she put it, get their act together. Now, this would, I should say, infect some 6,800 students at Harvard, foreign students. They will have to either transfer to another institution or lose their legal status that allows them to be in the United States. It doesn't just, and this is not just an economic hit on Harvard. It also would affect the state of Massachusetts, because these students don't just pay tuition. They also buy clothes, they go to restaurants, they rent apartments. So this has a ripple effect that's really has, again, shaken academia in this country.
John, thank you so much for keeping tabs on all those developments for us. Our Bloomberg editor, John Harney. Now let's take a look at how futures in Europe are opening. We're seeing a bit of a pickup and pointing to a positive session. But of course, the undercurrent to all this are some of these trade negotiations. And we are hearing also from the ECB chief talking about how when it comes to international trade, things are sort of forever changed. Keeping an eye on the euro as well. I think we're seeing that continued firming up in the single currency versus the greenback. More ahead on the Asia trade. This is Bloomberg. The Chinese mining city of Yichun has become central to President Xi Jinping's push to build a fortress economy, one that relies less on Western imports and more on its own resources and technologies. But this push to be self-reliant comes at a hefty financial and environmental price. For more on today's Big Take, Bloomberg's Dan Murtaugh joins us from Beijing. So, Dan, you were part of the team that traveled to Yichun to dig a bit deeper, excuse the pun, but what did you see there in terms of this cost that you're alluding to? Paint us a picture.
Yeah, so Yichun is a city in Jiangxi province down in southern China. It's a beautiful area, you know, fields of brilliant yellow rapeseed flowers, rivers and mountains, but it's become the lithium capital of China in large part because it contains this resource known as lepidolite, which is a really, really low-grade ore for lithium, which, as you know, is one of the key materials for the energy transition. It's in batteries that charge everything from energy storage to electric vehicles. But the problem is they built this industry a couple years ago when lithium prices were sky high. Since then, lithium prices have crashed. More supply has come online. EV sales outside of China have slowed. And in Yichun, a lot of these companies that they built up are now barely breaking even or losing money mining and processing this material. But they keep going, partly because the government is pushing them to keep people employed, and partly because this is part of a greater strategy. You know, it's not all profit-driven, and China does want to reduce its reliance on imported materials. We're seeing this in other areas than just lithium mining. China's putting a lot of pressure on its oil and gas firms to keep up production as well. It's the biggest importer of raw materials in the world, and it sees that as a vulnerability with increased pressure coming from the U.S. So it's trying to shore up and make itself a little bit more resilient.
Dan, we're looking at the chart there that Australia, Chile, a number of others, I'm sure, will be more than happy to supply China with the lithium it needs. But as you mentioned, this is as much about onshoring the supply chain as anything else. But you also point out it financially doesn't really stack up. Would China look at developing its own mines outside of the country?
Yeah, Chinese companies are investing heavily into mines outside of its borders. They're looking for resources, all kinds of resources, all over the world. But China's not the only country that is having a sudden, focus on supply chains and security of its material resources. Chile has long been the biggest supplier of lithium. It has the lowest cost, the production. But even there, the government is trying to take more and more stakes in production.
All right, Bloomberg's Dan Murtagh there with this week's Big Take. Thanks so much for joining us. Let's take a look at some of these key commodities that we track, particularly the oil price, interesting at the moment. Seeing Brent continuing to slip, now just above $64 a barrel, and we have heard that OPEC Plus may be considering another output increase in July. This is according to delegates who declined to be named. Should that happen, that would be the third consecutive production increase from OPEC Plus, possibly up to 411,000 barrels a day. We'll get a final decision on that at the June 1 meeting. The official line is OPEC Plus wants to satisfy demand here. Privately, it does look as much about punishing production sheets, recouping market share as much as anything else as well. Iron ore price pretty gamely holding on, just below $100 per tonne at the moment. We have more ahead on the Asia Trade. This is Bloomberg. Seeing some modest risk on sentiment in those markets across the Asia Pacific that are open. The Nikkei better by 2/3% right now. We do see JGB yields, though, higher again Friday. The yield curve steepening even faster than it is for the US. We had that hotter than expected inflation print out of Japan a short time ago. And in terms of providing verbal support for the bond market, well, we've had radio silence from the Bank of Japan for the past 24 hours. Well, let's get back now to the Beyond Expo in Macau, billed as the largest tech ecosystem event in Asia. And our own Annabelle Drillers is there with our next guest. Belle.
Thanks, Paul. Yeah, we've got the Macau Beyond Expo kicking into its second day. But joining me this morning is Oh-hyoung Kwon, partner and CEO at FuturePlay. So thanks so much for your time this morning. We were just talking about what's brought you here to the event, because you don't actually have any investments right now in China, but you still are interested in the potential. So what's standing out to you at the event?
Well, I think whole China community, I'm still in the early stage of understanding the whole China startup ecosystem is like. Also, we've seen what Unity has evolutionized the robot industry, and what DeepSeek and models have, starting to revolutionizing the AI industry. So I'm curious to learn about the whole ecosystem. And at the same time, I have a couple of portfolio companies with me, interested in getting into the China Chinese market as a potential market. So that's why I'm here for.
And we were also discussing fundraising plans. So you do have plans right now to target a bigger fund. So where are you at in terms of that?
So we're sector agnostic, stage agnostic, but we've been known as a good early stage investor. So we're as our portfolio companies grow, we feel that there's need for a bigger fund. So we're targeting $100 million fund, targeting early next year. We're in the very early stage, talking to potential investors.
And what's the conversation? How's it going? Because it's obviously quite a difficult environment now, rising tensions and higher rates still. So what's the receptiveness that you're getting?
Well, I think it's been always challenging when it comes down to fundraising, but it's been good so far because we've been focusing globalization, starting from Korea, and also we're targeting automation. So that's been huge. I mean, everyone talks about software, AI, robotics, but that's been always our main investment thesis. So everyone's been accepting so far.
You are involved in conversations with the Korean government in some capacity about building the startup scene in Korea right now. What's missing, or what exactly would you like to see?
I think the biggest part is the capital, and the Korean stock exchange is not performing as good as the U.S. market. I guess U.S. market is the exception from that aspect, but that needs to be corrected. Also, Korean startups are eager to go outside of Korea. So Korean market is big enough to start, but it's not big enough to scale for most part. So these startups need to go outside. So we're focusing on how to build global startups from Korea with the Korean government.
And what sort of mentality is needed then, and is that the mentality that you see when you meet these founders, that they actually have that plan from day one to go international?
Yes, I think the mentality is there for the most part. That's probably the main differentiation from the founders that I see anywhere else, like around the world. I think the Korean founders are very similar to the Israel founders, where the Israel has no market, but from the get-go, they think about the U.S. market as their first market, whereas Korean market is there, but it's not big enough. So probably the best strategy is to build the first use case in Korea, working with Samsung, Hyundai, LG, then target other big markets like Japan, China, U.S. So I think that mentality is there.
What's the technology that you think, where's the strength of Korea on a global stage? You mentioned automation before, but it makes me think again, going back to demographics trends.
Yeah, I think sadly, but not too sadly, Korea is becoming the most aged society. I think that has to do with that's putting a lot of pressure on replacing labor, both physical and intelligence. So, for instance, like if you look at the butchering industry, I don't know if you have ever been to the butchering factory, but it's been only been occupied by late 50s laborers in rural area. No one wants to work there anymore. It's hard to find the labor. So Korean startups or the companies have to automate the process. So naturally, we can have the best butchering automation company, robot companies in Korea. So those are type of things that we see an opportunity to become the first and the best of the technology can be developed out of Korea.
Going back to this $100 million fund that you're targeting right now, you haven't made investments in China to date, or you don't have an exposure right now, but would you be looking to deploy any of that capital, and if so, into which sectors?
Sure. I mean, we're always open to, it doesn't matter, we're geographical agnostic as well. We haven't really, we haven't had like too much of exposure in Chinese startup ecosystem, but what I see outside is DeepSeek type of companies that I haven't heard of. Maybe if a company that kind of blows my mind, but yet again, coming back to the realistic perspective, there's so many investors in China. We have to compete with them, right? I don't know what I can bring to the table, so that's my homework to do.
All right. Well, just last question quickly, sure. Relating to portfolio companies that you're bringing to China. What are the challenges that Chinese, Korean companies face when they come to this market?
I think first, cost. I think a lot of Chinese companies, the comparative advantage is aligned with cost and efficiency, and also not understanding the market well. You have to speak the language. You have to understand the culture. You have to have the right partner. I don't think the China market is open to foreign companies by itself. Just like Korea, just like Japan. So you have to find the right partner. So that's what we're here for.
Okay, some challenges for expanding here, it seems. That's Oh-hyoung Kwon, their partner and CEO at FuturePlay, Avril.
Thanks so much, Belle. Annabelle Drawless, our tech reporter. Now, let's take a look at how Japanese assets are looking, because it was a day where we got those Japanese CPIs showing the fastest acceleration in inflation in 2 years. But if you're looking at the yield in Japan, edging lower, interestingly, despite the data making the case for the BOJ to continue with its policy normalization, the yen is firming up a little, moving away from the 144 handle. But today, I think the undercurrent is still that sort of rebound we saw in treasuries. Maybe that's feeding into the optimism surrounding Japanese stocks. Certainly, the banks are lifting the gauges. And aside from that, also keeping a close watch on any form of trade talks between the US and Japan, hearing that the trade envoy of Japan heading to the US from today. More ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade, and we're continuing to keep tabs on those Chinese tech earnings. And one of them, Lenovo, especially keen interest there. Shares fell the most in more than a month after a worse than expected drop in profit, while the computer hardware maker posted its fourth straight quarter of double-digit revenue growth. Net income of $90 million was less than half the average estimate. Its Hong Kong listed shares and US ADRs both fell, despite that faster than anticipated 23% rise in sales to about $17 billion. Let's cross over to the China show co-anchor David Ingles, who joins us in Hong Kong.
Yeah, Avril, good morning, and thanks for having me on your show. I think it's critical at this point. Certainly, context and nuance is key here. It's very early in the day, and I've been practicing how to say HKFRS. And the reason that's important is because for this specific earnings out of Lenovo, of course, there's a nuance between the non and the there we go again, HKFRS versions of that. One is a non-cash hit. To your point, 90 million. If you take that out, that goes up to over 200 million as well. Let's get the context here from the CFO of the company, Winston Cheng, joining us here on set. Good morning and nice to see you.
Good morning. Thank you, David.
So, two sets of results. Why do we focus on the non-Hong Kong financial reporting standard version?
Yes, it is a mouthful, first of all.
Yes.
I think from our perspective, we issued the warrants as part of the ALAT transaction back in January. When we closed the transaction, we issued a zero coupon $2 billion CB, and then $212 million of warrants at the time. The warrants, unfortunately, have a fair market value gain in which if our stock price is higher than the reference price at the time of issuance, then we incur a loss. So if going forward our stock price reaches 20, we would have an even larger loss. So therefore, it's not reflective of our true operating performance. Because if our stock price actually went up, it's a reflection of our operating performance, and therefore it should not counter that in terms of our financials. So unfortunately, that amount, $118 million in the fourth quarter.
It's quite a big one, though.
Is a very big one. And it's actually included in our operating expenses and therefore negatively impacting our operating profit.
Okay.
The other impact is the zero coupon convertible bonds, which actually, from HKFRS accounting standards, actually allows us to actually charge a notional interest expense in the interest line below the operating income.
Right.
And therefore, we don't actually pay interest, but we need to charge the interest, and that's in excess of $22 million.
Right.
And so on top of that, so you really have a net impact well in excess of $140+ million into the net income, and therefore we would guide the street to look at our non-HKFRS net income going forward for the next 3 years, because that's the life of the warrants.
Okay, understood. And we don't know what the stock price is going to be, of course, over the next 3 years or so. One last question on that, though. It's non-cash, obviously. It's accounting reflected, though. This does not handicap you in any way, because this goes into retained earnings. Tell me if I should not be worrying about this.
No, not at all. Obviously,
Okay,
this is a cash amount, and I think upon the conversion of the warrants, clearly, we hope that with the conversion of the CB, which is $2 billion, we bring on board a very strategic partner for us in the Middle East by way of Lagarde and PIF, and therefore for us going into maybe even higher than that, the warrants would give us additional $2 billion of equity on top of the conversion of the warrants. So almost $4 billion of equity at the end of 3 years should both convert.
Okay. Well, let's talk about the underlying business. How do you think you guys did?
Well, it's an exceptional year. We're really underpinned by the AI trend in the market going on. In the PC side, AI PC is the talk of town for the last year. Obviously, very initial year and the initial stages, but that's tracking very well, slightly ahead of our initial estimates. Clearly, as component prices, key component prices to power AI PC come down, and also the important software application also improve, I think that adoption rate is going to increase. And we're estimating to be 60% of the overall market in 2 years' time.
The outlook then for the non-PC part of your business?
The non-PC part of our business, ISG business, is growing very fast. We grew faster in the market last year in our CSP business, the cloud service provider business, almost doubling, 92% year-on-year growth. So that's significant. And we made substantial inroads in the last year on that business, and one of our fastest growing business units. In our mobile business, we reached top 5 in the world last quarter, and in terms of revenue year on year, it's growing 27%, so faster than the overall group revenue growth of 21% year on year.
Okay. How is the tariff environment or the policy uncertainty directly or indirectly affecting the outlook here?
No, clearly it affects everybody who is operating both in the United States and other parts of the world. But I think for us, we're operating 180 markets. We are very adept to operating and complying to local rules or regulations. We have our own factories as well as partnering with other ODMs around the world with 30 factories. So from that perspective, we really can operate in our most agile in terms of responding to changing tariffs. Unfortunately, the current environment is such that the tariffs policy has been quite volatile.
Yeah.
So I think from that perspective,
it's been more agile than you're able to be agile.
Yeah, it's difficult for everybody when it's that volatile. Right. But I think the impact should stay consistent, and I think both it looks like China and the U.S. are coming to the table as the rest of the world, and there will be a policy. The market has voted in terms of the negative responses as it relates to the high tariff rates. But once things cool down and the reprieve is given to the market, I think the markets have also come up, right? So I think the markets have spoken, and hopefully the regulators will come to an agreement. I think we're ready to do business and provide our products at a low cost to any market, any segment. Yeah.
Your outlook then for competition and what that means for your pricing strategy moving forward. I mean, margins, is that a big issue? Do you expect to cut prices? How are you dealing with competition right now?
No, competition is a given in our industry. It's a highly competitive industry. I think we operate 24 hours a day in five major continents. For us, it's really about being agile and executing, and our products continue to innovate and execute. That's what Lenovo is famous for and very good at. We enable different brands around the world to be able to be successful through our acquisitions and through our partnerships. So leveraging our scale and technical capabilities. At CES this year, we won 75 awards for our innovative products with the rollable, foldable, and I think there's other technological innovation coming up. Okay. So these are things that you would do rather than using price with product differentiation.
Yeah. You're number one, right? PC shipments?
We are number one in the world. We're number one in 4 out of 5 geographies, and we're number one in both commercial and the consumer segment, as well as the gaming segment as well. So we're not only number one in terms of the world in just one category, but balanced across geographies and balanced across the subcategories. Right. And also in AI PC, in Windows-based AI PC, we're also number one in the world.
Quick CFO question before I let you go, and your new job, of course. Yeah. You look at the rate environment right now. Yeah. How is that affecting your plans for your borrowing mix? Yeah, clearly we're watching this closely. We've predominantly a U.S. dollar-based company in terms of how we operate around the world and so forth. On our debt, we generally borrow in U.S. dollars as well. It's expensive now, though. It is, and we're looking into other avenue streams. But a lot of our cost base is actually U.S.-based as well. Okay. So I think from that perspective, we want to make sure that that's matched. Yeah. We looked at the Moody's downgrade of the U.S. sovereign debt, of course, and I think the Treasury responses in the April timeframe, I think, was also quite interesting. But I think there's a lot of discussion around potential cuts this year, but I think also credit spreads may also widen, right? So I think we're keeping a close eye on this, but expecting probably total costs to stay relatively elevated for U.S. dollar-based instruments. So there are other capital markets dynamics, obviously, that we would capture that could lower our cost of borrowing. Fantastic. Winston, thank you so much for taking the time to come in. Let's speak again. Thank you, Dave. The next one. Winston Cheng there, Lenovo CFO. Paul, back to you.
All right, thanks, David. And coming up, we're going to take you back to the JP Morgan Global China Summit in Shanghai. We'll speak exclusively to ex-Peng President Brian Gu, as well as the bank's chief China equity strategist, Wendy Liu. More ahead on the Asia trade. This is Bloomberg. The Chinese automaker BYD has sold more EVs in Europe than Tesla for the first time, overtaking the American brand that long led the continent's EV segment. Bloomberg's Katrina Nicholas joins us now with more. So, Katrina, is this a story of BYD's success in Europe, or Tesla's not really done itself any favors in that market recently? What are the dynamics here?
Yeah, well, honestly, I think it's a little bit of both. I mean, these are quite extraordinary numbers that we're seeing from BYD. Up 169% their sales on April in Europe to about 7,200 battery electric vehicles. And that difference over Tesla was made even more stark when those plug-in hybrids are included. And plug-in hybrids are something that European consumers are really embracing now, given there's been some extra rules put around made-in-China battery EVs. BYD has really been hitting the milestones everywhere you look, both in its home market of China, now in Europe, Australia, parts of Southeast Asia. And it comes down to the fact that it's got a really appealing lineup of EVs and plug-in hybrids all across the price point from, the Seagull, which is quite a cheaper model, right up to some very high-end models. It's also putting its God's Eye technology into most of its models. This is its advanced driving features. That's proving very popular with consumers. To your point about Tesla, though, I mean, you're right, Tesla is not really doing itself any favors. I mean, a lot of consumers have been put off Tesla cars because of Elon Musk's involvement in politics. He has pledged to step back, as early as this week, saying he's definitely going to be spending more time focused on his EV maker. So I think we'll see, how long it takes for that sort of consumer perception about Tesla and what a Tesla car stands for to sort of fade a little bit.
Katrina, do you see all this, in a way, reshaping not just the European EV, but also the broader auto market?
I think you would have to say, yes, that is fair. I mean, BYD has really, from let's say 4 or 5 years ago, you would hardly call it a household name. I wouldn't say it's a household name just yet, but I think you could safely say that consumers in many parts of the world actually know what a BYD car is. They're not a foreign thing anymore. And that's because they have been so successful going into these markets. It's even more extraordinary when you think about the fact that BYD is not even in North America. And this isn't because of Trump tariffs. It's because it's been locked out of the market along with many Chinese EV makers because of Biden-era tariffs that make it prohibitively expensive to sell into that market. So it doesn't sell any passenger cars into the US, and instead it's had a very deliberate strategy of looking at, okay, what other parts of the world outside of China can we go into where there's, the EV market is just getting started and consumers are just starting to make that switch and are ready for, a good-looking car at the right price point. And that's seen it really gain a foothold in Europe, certainly in parts of Southeast Asia, Australia, as I mentioned, and also increasingly Latin America.
All right, Bloomberg's Katrina Nicholas there. Let's get the latest from the corporate front. OnlyFans owner Phoenix International is reportedly in talks to sell the company to an investor group at a valuation of around $8 billion. Reuters cites anonymous sources saying the owner is also considering an IPO and fielding interest from other suitors. The London-based platform said last year it had paid out $20 billion to content creators since it was founded in 2016. Bloomberg has learned Apple is looking to release smart glasses at the end of next year in a challenge to rival Meta's Ray-Bans. Sources say the glasses would have cameras, microphones and speakers and handle tasks such as phone calls, music playback and live translations. Meanwhile, Apple has shut down work on a camera-equipped Apple Watch and is still looking at AirPods with cameras. Well, that is it for the Asia trade markets. Coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.